You're watching MC Explains, an investor education initiative that's brought to you by Moneycontrol and Invesco Mutual Fund. Following market regulator SEBI's categorization and rationalization of mutual fund schemes in 2017, the basket of hybrid funds has been clearly segregated into 6 different types. The basic premise of hybrid funds is that they invest in more than one asset class. So it could be equity and debt, which is the most common style. But some of them can even include commodities and arbitrage. The most popular type of hybrid fund is the Balance Advantage Fund, also known as Dynamic Asset Allocation Fund. As of end October, the assets under management under Balanced Advantage Fund was as high as 2 lakh crore rupees. So what's behind the popularity of this fund? Well, Balanced Advantage funds are dynamic in nature. This means that the fund manager can actively choose to allocate between equity and debt in any proportion according to prevailing market conditions and the fund manager's own outlook of where things are headed. The idea being that the equity exposure provides growth and opportunity for returns, while the debt exposure provides stability. As well, the fund manager can also hedge his equity positions, and this is something which also helps to limit losses when the market slips. But not all funds are created and managed in this fashion. Every fund manager is free to decide the model or the strategy behind their Balance Advantage fund. For example, for some, the trigger to decide allocation shifts between equity and debt could be valuations. When stocks are expensive, they shift to debt, and when stocks are cheap, they add to equity. The basic premise being buy low, sell high. Then there are others who follow the trend or the momentum, buying stocks which are rising, as denoted by the price to earnings multiple. This basically means they have a higher equity allocation when the market is rising and they trim it in a falling market. Balance Advantage funds are mainly used to provide downside protection to portfolios when markets are volatile, ensuring a smoother ride. And what's more, they are taxed as equity funds, which means short-term capital gains of 15% and long-term capital gains of 10%, with the first 1 lakh of gains being exempted. And managing volatility is not their only strength. They have also generally provided healthy returns across time frames, at least they have to. Another important point to consider is that different Balance Advantage funds may also carry different risk levels depending on their own strategy. So, make sure that you check all these factors before you start investing. The second largest hybrid category is the Balance Hybrid or Aggressive Hybrid funds. These two types of schemes, balanced and aggressive, are not the same. An AMC can choose either one, but they can't offer both. Another point, this Balance Hybrid fund we are talking about now is different from Balance Advantage funds that we spoke about earlier. So what is a Balanced Hybrid fund? These funds can invest between 60 and 40% of the total assets into equity and equity-related instruments, and correspondingly, they would invest the balance in debt instruments. So, for example, if a scheme has 40% in equity, then balance 60% has to be debt. Or if they have 60% in equity, then the balance 40% has to be in debt. Since allocation to both asset classes is plus minus 20%, the name Balanced Hybrid Fund. According to SEBI rules, no arbitrage fund is permitted in this type of fund. And on the other end of the spectrum is the Aggressive Hybrid Fund. As the name suggests, it is predominantly equity oriented and so can invest between 65 to 80% of its total assets into equity and equity related instruments. And conversely, the balance 20 to 35% would be in debt. The third type of hybrid fund is the Conservative Hybrid Fund. Again, the name is self-explanatory. This scheme is predominantly debt-oriented. which means they are permitted to invest between 75 to 90% in debt and the balance 10 to 25% in equity. Of late, the multi-asset allocation funds have also become very popular. This type of hybrid fund must invest in at least 3 asset classes with a minimum allocation of 10% each. The most popular combination is equity, debt and gold. And besides the mandated 10% allocation apiece, it depends on the fund manager's strategy how much they wish to allocate to each asset class. The biggest advantage of this scheme is that it offers the benefits of diversification. Along with the favorable taxation of debt funds, that is also an advantage it offers. Another kind of hybrid fund is the arbitrage funds. These are schemes which follow the arbitrage strategy. The fund is also mandated to maintain a minimum of 65% of total assets in equity and equity-related instruments. So, what do we mean by arbitrage? Arbitrage is the strategy of generating returns by exploiting the difference in prices of the same security in different markets. So, the fund manager is simultaneously buying and selling the same underlying in different markets. The excess earned is the return generated. The act of buying and selling simultaneously means that no risk related to price movement is carried over. Therefore, arbitrage funds are considered a part of the low-risk basket and are probably the most tax advantageous. Since minimum 65% has to be invested in equity, they enjoy the tax status given to equity funds. So, if you compare arbitrage funds to a bank fixed deposit, you have superior post-tax returns. Another point to note is that arbitrage funds work especially well in volatile markets when there are higher probabilities of market inefficiencies. The final kind of hybrid fund is called equity savings. These schemes must invest a minimum of 65% and a maximum of up to 90% in equity instruments. The remaining 10% gets invested in debt instruments. Now, this might sound like your typical equity fund, but it isn't. While an equity scheme is meant to take an equity type of risk and give you an equity type of return, equity savings funds are conservative in nature. They aim to give moderate returns. That is why equity savings schemes invest in arbitrage opportunities or derivatives. Typically, and of the equity exposure, it invests 10 to 50% in arbitrage opportunities. The remaining of the equity allocation is invested in unhedged equity. How much equity savings scheme invests in unhedged and hedged equities depends from scheme to scheme. So, there you have it, the 6 types of hybrid funds. Almost any kind of investor can find one of them which works for him or her. I hope you found this interesting. Thanks for watching.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.